Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Now, over the past week, US bond markets have been quite a big area of focus with the benchmark 10-year yield approaching very, very close to the 5% level. I came across one interesting chart in my readings that illustrated that if you look at the US Treasury bond market, total returns, and put that in a long perspective, what we've experienced past year to year and a half has been one of the worst, if not the worst, bond market, bear market. It's going back all the way to the 1920s. So we live in interesting times. And, to discuss that and, of course, what to make of the Israel-Gaza conflict, we're joined by Audrey Go, who's head of asset allocation and a familiar voice to many of you. So welcome, Audrey. Treasury yields, let's talk about that first. Do you believe yields can rise further, or are we at a turning point for Treasury yields? And what exactly does that mean from a portfolio allocation perspective?
Well, thanks, Manpreet. So the technical indicators that we monitor, such as those on investor diversity, relative momentum, those does suggest that we might be close to a turning point for bond yields and for global markets. From a data perspective, if you look at US growth, it continued to look very, very resilient. The US retail sales this week, for example, was much stronger than expected, and initial jobless claim also fell to a 9-month low. So certainly this sustained strength that we are seeing in the US economic data has contributed to the surge in US bond yields and the US dollar in recent months. However, if we look at it from a policy perspective, developed market central banks may be close to taking a pause in their rate hiking cycle in our view. So we do not expect the Fed to hike rates any further this year, as we believe that growth is likely to slow in the coming quarters, given that the tightening following the 525 basis point of rate hike since March last year, as well as the latest surge in bond yields does tighten monetary conditions. And if we were to look at Fed Chair Powell's latest comments as well, he also suggested that the recent bond yield surge has also lessened the need for further rate hikes, supporting our peak rates view. So against that backdrop, in terms of portfolio allocation, we do continue to favor the developed market government bonds, where yields looks pretty attractive, and historically the US 10-year bond yield also tend to peak with the Fed rates. So if the US 10-year bond yield, say, peaks above 5%, then to us, the next major resistance will probably be close to about 5.25%, which is just below the likely peak Fed policy rate. So after the recent surge that we have seen, yields on the benchmark US government bond index will have to rise by over 90 basis points from here in order for bonds to deliver negative returns over the next 12 months. Therefore, from a risk-reward perspective, we do find developed market government bonds pretty attractive despite some near-term volatility. Now, in terms of equities, the S&P 500 index has failed to break above the convergence of its 50 days and 100 days moving average resistances for the last couple of weeks, although net is still remain above the long-term 200 days moving average in terms of technicals. So in our view, we do believe that we would likely need to see a pullback somewhat in the US 10-year bond yield, as well as a decisive reversal in the US dollar for global equities, as well as the broader emerging markets to recover. So from an equity perspective, we do have a core allocation or neutral allocations to it. Now, you spoke about the Gaza conflict earlier. So in order to hedge against a potential escalation in the Israel-Gaza conflict, as well as potential upside risk, say, in bond use as well, we would also advocate investors to add some exposure to, say, the energy sector, as well as the defense sector equities, and of course, gold. And in terms of gold, we see the next resistance at around 1,990, and then followed by around 2,000 level.
Thanks, Audrey. Quite a lot of insights there to digest from multi-asset portfolio perspective. But diving a little deeper into another asset class, emerging market local currency bonds. They're not directly linked to dollar bond yields. But what's your view on this asset class, given the turbulence we've seen on the dollar bond market side?
So emerging market local currency government bonds, they have been hurt by the recent surge in bond yields, as well as the stronger US dollar. But despite so, the spreads against US government bond yield, which is typically a measure of credit risk, has actually further compressed. So we do expect the EM local currency bonds, government bonds in this case, to have a relatively decent probability to outperform over the next 6 to 12 months, given our expectations in terms of policy easing in the EM. So some emerging markets, for example, in Brazil, Chile, Hungary, for example, they have already started cutting policy rates as inflation pressure has eased. And we do expect more emerging market central banks to actually join the pack. And most central banks across the board actually have pretty high real policy rate, which means that there is actually plenty of rooms for rate cuts in our view. And if we look at overall EM economic growth, that is likely to remain resilient over the coming year. Consensus expect EM economies to grow by around 4% year on year in 2024. And this positive macro backdrop, in our view, could also help improve the sovereign credit matrix and thereby sustaining the spread compression that we are seeing today. And then last but not least, certainly a dollar. We do expect a weaker dollar as well. And a weaker dollar generally bodes well for EMFX. And under our central scenario of a weaker US dollar, we do expect EMFX to strengthen, and that would then add to the prospects for positive returns when it comes to EM local currency bonds.
Okay, and then maybe moving over to the equity side, the key event that's kicked off, of course, is the US Q3 earnings season. I know it's still early days, but what are you observing as interesting, particularly from the financial sector that has started to report?
So we have seen over a third of the financial sector reporting so far, and collectively the sector delivered around a 9.8% positive earnings surprise. So high interest rates, loans growth continue to support net interest income. While at the same time, if you think about the provisions or the loss provisions made by the banks, they were not as bad as feared. Then in terms of capital market as well as investment banking advisory fees, those were soft as expected given the volatile markets that we have seen through the last 2 quarters. If you think about forward-looking outlook, banks management actually sounded a little bit more cautious in their outlook, given their expectation that net interest income will likely come under pressure as the banks gradually adjust to paying higher rates to depositor. And not only that, there are also weakness in the office commercial real estate sector that's also becoming more apparent as valuation appraisal weakens. So loan loss for the segments is climbing, and there are expectations of potentially more to come. So overall, the sense we get is banks are responding with strategic action to control their expenses heading into 2024. So more of a cautious outlook, really control expense in an environment of a really pretty uncertain macro backdrop. Another concern for banks has been on the impact of rising yields in terms of potential losses in the bank's bonds portfolio. So, among the larger banks, this risk appears to be largely contained, given that potential losses look unlikely to be realized, given that these bonds comprises mainly of US government bonds, which are expected to be fully repaid, as long as the banks can hold them to maturity. So, net, we have a neutral view when it comes to US financials, and we expect the sector to perform in line with the broader markets, US equity markets, over the next 6 to 12 months.
Okay, I think that's all we have time for today, so we'll end it there. Thanks so much, Audrey, for your time. I think that was definitely interesting conversation. If I can, as always, maybe sum up my top takeaways. First thing that comes across quite strongly, of course, is the opportunity in high-quality government bond yields, where the bond yield itself, of course, now offering quite a sizable buffer against a further short-term rise in bond yields. I think that's the first opportunity that came through. Second, of course, potential hedges against an escalation in the Middle East conflict, energy sector equities in the US and gold, of course, being two candidates as specific hedges against that. And third, of course, emerging market local currency bonds potentially offering another opportunity, somewhat away from US dollar bond markets alone. So those are sort of my top three takeaways. Thank you, listeners, for taking the time to join us today. We hope you found it interesting, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.